Welcome to Bubbles, Panics, and Depressions, Week 12. So, class, this week we're going to talk about Krugman's concept of return to depression economics, and then we're also going to talk about some other economic models and other crises in other parts of the world, Asia, and then Latin America. So, let's start with Krugman. Krugman's concept here, by the way, Krugman is a professor of economics at Princeton University, and he's also a commentator for the New York Times, and so he's a pretty prominent economist. His book is really trying to address the issue of a post Keynesian approaches, and he is, quite frankly, he's a Keynesian himself. Um, and so he believes that there's kind of a return since the 1980s, a return to laissez-faire economics, and a move away from Keynesian approaches to managing the economy with fiscal policy, with fiscal stimulus by the government. And he's deploring this. He doesn't like this. But what he does in the book is use some examples from other parts of the world, from Asia and then Latin America, to really demonstrate that a Keynesian approach is still needed. What I would say to Krugman is that actually I think we're actually still in a kind of Keynesian, or what I would call neo Keynesian approaches to the economy. I don't think we've gone down the laissez-faire road quite as far as Krugman is arguing. Um, uh, the thing is, you look in the 90s and in the 2000s, and the American government actually, under Bill Clinton, used a stimulus package, and under George W. Bush, used a stimulus package. So this is still a Keynesian approach. Now, many economists in this time period, in the post-Keynesian period of the 1980s and onward, have believed that you can do economic management, manage the cycles with monetary policy, with the Federal Reserve essentially managing interest rates and how much money is in the economy. But I think Krugman is probably painting the picture a little too white and black in those terms. Now, um, so let's move off of that and let's talk a bit about some economic alternatives. Some really, these are still capitalist economies, but in the case of Japan, for instance, you have a capitalist economy that actually runs quite a bit differently than the American model. Let's talk about Japan. So after World War II, the Japanese economy is devastated, and then by 1985, the Japanese economy is the number two in the world. It's growing fast, and some scholars are predicting that Japan will actually overtake the United States and become the number one economy in the world. There's actually anxiety in the United States about this. In Detroit, for instance, uh, workers at GM plants, they walk out of their plants and they see some some of their coworkers are actually driving Japanese cars, so they take hammers to them and they destroy them. So there's anxiety about the Japanese overtaking us. Well, it didn't happen, but the Japanese economy is a major success story after World War II, and it works like this. The Japanese economy is based upon industrial planning. The Japanese government has an agency called MITI, that Ministry of International Trade and Industry, that does a lot of their economic planning, and and then the Japanese focus on production. They protect their own producers locally, import controls, tariffs essentially, and other sorts of import controls to prevent goods from coming into the Japanese economy. They had, of course, the benefit of the U.S. Military umbrella, so they didn't have to spend money on a military. This was a big savings. And so the Japanese economy grows somewhere between 6 and 10% annually between 1950 and 1980. It's really dramatic growth. Um, what we've learned is this kind of growth is actually not sustainable over the long term. And we'll see with China whether or not this is true, because China's at about 7% right now. They used to be at 10%. My guess is in 15 years they'll be down to 2 to 4% per year. But how did Japan do this? Well, it's capitalism, but it's a different kind of capitalism. So we talked some about that, and we talked about their success. Now, in the 1980s, the Japanese have begin to have some problems, especially in the late 1980s. Their economy is growing so rapidly that it's beginning to overheat. But in 1987, the U.S. stock market crashes. The Japanese are well aware that it's American money that actually fuels the Japanese export economy. So the Japanese decide to lower their interest rates in Japan to try to produce some economic stimulus and support the world economy. And in some respects, you could argue that they actually succeed in this. Because the American economy looks a little shaky, but the Japanese economy is actually supporting world consumption and production in this time period. But so they lower interest rates, and this produces even faster economic growth. So in 1989, they're very concerned about this. By this time, they have a housing bubble. Property prices in downtown Tokyo, about $3,000 to $4,000 for a one-bedroom apartment, renting that for a month. So the market has gotten out of control. And so the Japanese government raises interest rates 5 times in 1989. By the way, does this sound familiar? It's almost exactly the same scenario as the United States, the New York Federal Reserve before the Great Depression. They lowered interest rates, the economy overheats, then they raise interest rates and they do damage to the economy, send the economy down. Sure enough, the Japanese real estate bubble burst. Banks were left with all of these bad mortgages. The banking system got into trouble, and Japan experienced about 15 years of economic deflation, where they simply didn't have any economic growth for 15 years. And they didn't respond very well to the banking crisis. They left these bad mortgages on the banks' balance sheets. Basically, said the banks could ignore those those bad loans, which is bad for the economy. It's a drag on the economy. And so it wasn't and they also had some problems with the way the Japanese government was running things. The Japanese government would spent a lot of money supporting retired bureaucrats who would get offices in fancy buildings, and they wouldn't essentially they weren't doing anything. They would go into the office and then they go play golf at 3 o'clock, and this was called a makudari, or ascent to heaven, and this was a very bad practice. It cost the Japanese government a lot of money. So that the Japanese government ends up with an enormous public debt of about 170% of the GDP. And it's still the case today. The one caveat with the Japanese debt is that it's held by Japanese citizens or corporations. And that means that as long as these citizens and corporations think the Japanese system is going to be okay, they'll continue to fund the debt. So the Japanese essentially don't have to worry as much about the debt as if it was held internationally. But finally, in 2005, they get a stronger prime minister, Koizumi. He reforms the Omakudari system. He does some stimulus, and the Japanese economy begins to grow again. So a 15-year deflation. Now, what happens is the rest of the world watches this. And in particular, the United States earlier this year was a little bit concerned about the lack of inflation. Yes, that's correct. The Federal Reserve of the United States has expressed concern that there was not enough inflation. This is why I argue that Krugman has actually overstated it a little bit. Because, of course, Keynes was a proponent of some inflation. And now we find that the American government in the Federal Reserve is a proponent of some inflation. Because if you don't have any inflation, then you don't have any economic growth. You don't have anywhere to go in terms of growing the economy. Okay, so the Japanese situation is they've finally begun to grow. They have a pretty massive stimulus program going on, and they're also using monetary policy, trying to reduce the value of the yen versus the dollar, so that their products will sell. They'll be able to sell more products overseas. Okay, So that's the Japanese situation. It's very interesting. In the post-war period, they pursued this different approach, and we'll see if they can continue to pursue a different approach and still have economic success. Now let's turn to the Latin American economies. Oh, sorry, no, let me talk about the Asian financial crisis first for just a minute. Now, Krugman addresses this in his book, but let me just summarize it very quickly. So this starts in Thailand, and the Thai economy is being driven by the the setting up of industrial enterprises, that basically the offshoring of enterprises and production facilities from the United States and also from Japan. And so they're benefiting from this, and their workforce has got work. Companies like Nike are building their tennis shoes and other things in Thailand because labor costs are really low, really inexpensive. So Thailand is having tremendous economic growth. They're very prosperous in the mid 1990s. But they begin to develop a currency problem in 1997. Okay, their national currency is called the baht. And in 1997, the Thai government is actually propping up the value of the baht. The value of the baht is actually declining. You see, the problem for Thailand is they can't do business internationally with the baht. And so they have to have dollars to do international business, international trade. And so the baht is pegged to the dollar, and they don't want to see that the value of the baht decline against the dollar, because a lot of Thai citizens actually have their savings in baht, not dollars. And so they'll lose a lot of money if this currency declines. So the government is pegging up to mollify the population. The problem is that in reality, the baht is beginning to decline as the world economy slows down a little bit, and there's less demand for production coming out of Thailand. And so the baht begins to decline, which essentially means that everything else is more expensive locally in Thailand. And the debts of people who have bahts, have their debts in bahts, which is most Thai people, are beginning to grow. And then all of a sudden, in 1997, foreign investors begin to remove capital because they see a crisis developing in Thailand. So they pull out capital. This produces more inflation and more real devaluation. And eventually the Thai government they simply have to admit that, okay, the baht is not worth that much. And they do a devaluation. And this sends the economy into a recession. And it also, it has a knock-on effect, because all of the Asian tigers like South Korea, Malaysia, Singapore, Indonesia, they're all linked into this same basic. They're producing things. They're part of this offshoring and producing things for a world market. But essentially, these are simple export markets, and the people in the countries they don't have a large middle class. They're relatively poor countries still, and so all of these economies actually go into recession. And it's only really the International Monetary Fund which steps in and brings in more capital, uh, makes loans to these Asian economies, that helps these economies to recover. And then you see some Asian economies do extremes, like Malaysia actually puts foreign capital controls on, where they won't allow foreigners to make certain kinds of investments, or they cap it at a certain amount of money that can be invested, because then you don't have this problem of the capital flowing very rapidly out. But this is an example of what Krugman is arguing is a return to depression economics, is this kind of volatility that you see in the developing world economies. Okay, let's turn to Latin America. And essentially, I'm mostly going to talk about Mexico. But Latin America, of course, is traditionally based on silver, because there's lots of silver production in Latin America. And it's traditionally been inflationary, because there's more silver, and so they could print more money because they had more silver. But eventually they print too much money, and it becomes inflationary. And so you can see happening time and time again that Latin American economies get into trouble with inflation, and then their export markets dry up, or there's some sort of crisis, and then they have a real issue because their own currency has been so devalued by inflation. Okay, and this happens in Argentina. It's actually kind of happening in Argentina right now, that their currency has become devalued against the dollar, but they're trying to prop it up, and their inflation is high, and it causes economic instability. So Latin America has chronic economic instability. Now let's talk about Mexico. And sometimes the crisis of 1994 is called the tequila crisis. And here's a little bottle of tequila that my son got for his graduation, and thank goodness he hasn't drunk any of it. So that's a good that's a good thing. So the tequila crisis started with the NAFTA uh, treaty that was signed between the United States and Mexico and Canada, which is the North American Free Trade Association. And so NAFTA actually uh, tore down market barriers in Mexico. It it forced the Mexicans to operate in an international market. Previously, the Mexicans had, for instance, subsidized the price of corn because corn is so important to making tortillas, and it's a basic foodstuff for the Mexican people. But in NAFTA, it required them to get rid of price controls and subsidies, and so the price of corn actually plummeted in Mexico, and a lot of these farmers got into trouble. And so other commodities, the same thing. And it produced by 19, this agreement was signed in 1993. By 1994, there were already some signs of economic distress in the Mexican economy. For one thing, the same problem as the Thai economy, the Mexican peso had been in real terms devalued against the American dollar. But the Mexican government had propped up the peso. And in fact, 1994 was an election year, and so they were actually printing pesos in addition to propping up the value of it, artificially setting the value of it. They were printing pesos, so it's a kind of double whammy. The peso wasn't worth what they were saying it was worth, and then it was declining because of the printing of money. So um, July 1994, all of a sudden the Mexican economy uh, has this incredible deflation where production drops dramatically. Industrial production drops by 15%. The GDP drops by 7% in the space of 6 months. And so the Mexican economy is in big trouble. The United States decides to step in, and they give Mexico a $50 billion loan. And so this really solves, in the short term, the economic crisis of Mexico, and it pulls them out of that tailspin. And so what you have is a world economy in which and Krugman mentions this, in which globalization and the production of and the creation of new technology has spurred lots of economic growth. But some of these economies are actually still quite vulnerable, like the Mexican economy or the Argentinian economy. And when they have to compete on a global scale, their economies are not particularly competitive. And so we have to be aware that these economies are going to be more volatile than some of the other economies. But it's interesting to look at some of these economic alternatives, like the Japanese economy and their approach to their economy. Okay, we'll talk again next week.